Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment, the podcast. My name is Jeb Graham, here with Ethan Hutchison and Eric Wymore. How's it going, guys?
Good. Nailed the intro.
There we go. That's right. The only part of this thing that went well right here. It's the intro. So no, just kidding. But great. We're into summer. I guess today's June 17th, so it'll probably end up being, around 4th of July when this comes out. And we also have, last night we had Messi score a hat trick. Did you guys get to watch the game at all? So that was a neat time.
Oh, of course,
yeah. That was a neat time for Kansas City for sure.
Yeah, it was cool.
And he also tied the all-time World Cup goal scoring record. So, which is pretty sweet. So, anyway, what we wanted to do today is talk a little bit about, and we've been talking about this for a little while, which is what is the cost of waiting or procrastinating working with a financial advisor? And I think all of us, through the business have had people that we've talked to over the years that have said, hey, I need to sit down with you. Or, I'm thinking about hiring a financial advisor, and then you'll see them 5 years later and they'll have that same discussion. Right. And so basically 5 years have gone by without them basically acting and kind of putting something into place. And I'll tell you that research would show, and this is according to Vanguard, that households with a written financial plan are 2.5 times more likely to save enough for retirement than those without one. And what's interesting is kind of very few Americans actually have one relative to the overall population. Only 36%, according to Charles Schwab, have a written financial plan. And of the 36% that have a written financial plan, 75% of those say that they feel more in control and comfortable with their finances. And then to kind of piggyback on that, there's Vanguard research that also suggests that a quality advisor can add approximately 3% in annual value through behavioral coaching, tax planning, rebalancing, and other planning strategies. So those are all, the thing. I think people think of financial advisor and they want to get 7% on their portfolio versus 6% on their portfolio, or 10% versus 9%, 15% versus 14, or whatever it is. And I think some people just forget about the overall value that's added by having a personal CFO and having a financial advisor. So, which are synonymous terms, by the way, when we're talking about a financial advisor and a personal CFO. We would consider a personal CFO kind of a higher level financial advisor. So the challenge becomes when you wait is that there's certain value that you never capture. And in our experience, the longer somebody waits, the less obvious the impact feels until they look at it backwards in hindsight. So let's talk about some of those missed opportunities that people might have.
Yeah, I think I wouldn't say it's the most important one, but one that does occur on an annual basis is going to be missed tax opportunities. Not filing. I mean, I hope you file your taxes every year and you don't miss that one. But other strategies around taxes, and I don't mean, saving taxes every year. There's a lot of different things that are tied to the tax picture of someone's financial plan. So you look at a married couple with a couple of children, and they might be making $210, $215 a year. Well, they can contribute to a Roth IRA, but every year they don't do that. That's 1 year that they can't go back and contribute to a Roth IRA. And we're kind of looking at tax brackets to make those contributions. Tax loss harvesting occurs most oftentimes. There's opportunities for tax loss harvesting on an annual basis as well. Sometimes the market's just rip roaring and everything's got gains and it's hard to find those losses. But every so often we'll have a correction during a bull market. We might have a 10% correction. There might be an opportunity for tax loss harvesting. And you might be thinking about that if you're a DIY investor, but you don't know when to act or kind of how to do those strategies. And so the advisor comes alongside, you as the client and assists with those. I think a big one is Roth conversion timing. Everyone's heard of Roth conversions. They've been around forever, but they've really come to the forefront lately with the future possibility of income tax increases down the road. So people are thinking, I'm going to have $5 million at retirement. Everything's going to be in pre-tax. I'm going to have a big RMD. I'm going to have a $700,000 required minimum distribution when I'm 83, and that's a very, very glaring number. So leading up to retirement, what do we do to plan for a Roth conversion? We work with a lot of engineer clients around here that have these large ESOPs and 401ks that are all pre-tax. And it's interesting, they might retire early, 50, 55, 60, and they might have said, man, I wish I would have got introduced to you 10 years ago, because there's a lot of planning leading up to that retirement that we could have done to help ease the burden on some of that large pre-tax buckets of money that are there. So I don't think it's one-time events that people miss out on. It's definitely there are annual windows of opportunity. Whether you're 45 years old making good money and want to exercise some stock options, all the way up to Roth conversions and more in-depth tax planning strategies. The longer you delay, the more missed opportunity occurs. And I think the more missed opportunity adds to itself, because like I said, every year that goes by that you don't act on one of these strategies, that's another year that goes by that you can't go back in time and do that. So something to think about. There's a 5-year delay isn't one missed plan. It's 5 missed cycles of efficiency and optimization. So think about that from a tax perspective when you're kind of juggling. Should I call an advisor? Should I just do it myself? There might be some things that we could be able to help out with that you might not know. So on the tax side of things, there's definitely a lot of investment opportunities. So Eric, if you want to chime in on some opportunities from the investment side of the equation.
Yeah, absolutely. I think a lot of investors, think that doing nothing is the safest course of action. And generally speaking, that is, you want to make sure that you're putting away money into your retirement accounts or into other investments on a regular basis. But in reality, portfolios, they're a living, breathing financial tool. And if you leave them unattended, they tend to drift away from their original purpose. And that can certainly create those risks that aren't visible until it's too late. And when we're talking about that, a lot of times we're talking about portfolio drift, right? Portfolio drift certainly isn't something that happens overnight. Markets, tend to go up, and what that happens is oftentimes you'll see a very small, concentrated position that goes up much faster than everything else. We've seen that over the last couple of years in the markets, and that position, what started as kind of a smaller position, is now much, much larger. And when you thought you had a balanced portfolio at the beginning, now can become more of a concentrated handful of stocks, sectors, or asset classes. Again, we're seeing that a lot over this last few years. And I think there's that thought that comes across in investors' minds that it's like, if we looked at it today, does this strong performance that we've had, this strong recent performance, is that indicative of a healthy portfolio? And that's a question that we need to ask, right? Because it might not be. It might just be that we're hitting the right time, and we need to reevaluate what things will look like in the next few years. Because that creep is real. That risk creep, it creeps in. It is real. And if you think about it, a few years ago, what was a 60-40 portfolio that we'll often talk of? 60% of your money's in stocks, 40% is in fixed income or bonds, kind of that stable position. Well, over the course of time, over the course of the last few years, it's probably shifted more towards 70% stocks, 30% bonds, or even 80% stocks, 20% bonds. And the danger isn't that poor performance, is just discovering that risk when the market turns, right? And that's what we want to make sure, that if you're always looking at your portfolio, looking for opportunities to rebalance. I think the other thing is that the goals often change, right? Your investments might not. Someone that's 45 and is in that accumulation phase might be a little different risk tolerance their portfolio might be a little bit more inappropriate for someone that's 65, that's nearing retirement. So income needs evolve all the time. Family circumstances change that need to be addressed. And if you don't don't address your portfolio, you're at risk for some kind of a market turn that could, you could find out at an unfortunate time. And I think the last kind of point I'll make in this subject is the account sprawl that happens with kind of the do-it-yourself, situation where all of a sudden you'll have some old 401ks that are spread out there because you've worked at a couple of different jobs, or you've got a couple of different IRAs, or you're looking at, different brokerage accounts or non-retirement accounts, and so to speak, and just the sprawl, and no one out there is looking at some kind of a consolidated view for you and your financial picture. I definitely think that that's something that's a real risk, that needs to, or that can pop up in the portfolio. So just keep in mind, the portfolio isn't a crock pot, right? You don't just put it in, dump it in, set it and forget it. It's something that you need to constantly review. And the cost of waiting, again, you're going to find out at some point in time if you reset your portfolio the right way, whenever that market pullback happens. So, and I know, but all that can be kind of more of the behavior situations, and that's what Jeff's covering now.
Yeah. So all of both of those are, kind of relatively technical, and they're super, super important, right? Tax opportunities. You got out of balance portfolios, do it yourself drift, things that basically aren't being tended to. I'd say this is where the thought of hiring a financial advisor is incredibly underestimated as to the power of what it does for an individual. And that's the behavioral benefits of having a financial advisor and somebody to kind of walk you off the ledge during times where maybe you get off course, or you think about doing something that you typically probably shouldn't do. And to give you a couple examples of that, we've all seen it as financial advisors, whether you're thinking about back to 2022, when the market went down, significantly, the bonds went down significantly. You can say that about the great financial crisis. I was in the business then too, but selling at the wrong time, right? So you have somebody that basically sells out of fear. And we've seen it a million times where the market goes down, they get worried, they sell at the bottom of the market when it's down 15, 20%. Lo and behold, the market pops back up over the next month and a half, and they just took a 20% loss and basically didn't benefit from the gain. And a lot of times, even the slingshot effect to where the market goes past where it was before and starts to make money. So that's a behavioral issue that a financial advisor typically is going to help you through. And then when you look at and same thing there, we just talked about that, is moving to cash after the market declines. So that would be also, selling low or selling at the wrong time. And then, one that I think is probably more prevalent now than it would have been, even, and maybe back in 2021 as well, which is chasing returns. We have and I think this is kind of timely because SpaceX just went public last week, and you want to talk about, what's the most frequent call you guys have gotten over the last 3 to 4 weeks? It's, hey, how are we going to get on SpaceX? We know that it was going public at a $1.75 trillion valuation, crazy valuation. There's amazing statistics. I wouldn't say amazing statistics, but very solid statistics that would say that in the first year of an IPO, most of those companies experience a very significant drawdown. And the average drawdown, I can't remember what the stat I saw was, but it was like in the 30% range or so. And that's when you're talking about a lot of the big IPOs that have happened over the last decade, right? And by the way, this is by no means a prediction of what SpaceX is going to do, because maybe it does, beat the rule, and it does end up just continuing to go up. And there is reason to think that's possible, right? However, what happens is people start chasing returns. And so not only do they sometimes sell things at the wrong time, sometimes they might buy things at the wrong time because they have that fear of missing out, right? And that's kind of our job is, and I'll tell you, the clients that we've had that called wanting SpaceX, some of them bought SpaceX. My recommendation to them has been, hey, let's give it a month or two. Let's see kind of what happens after the initial hype is gone, see if it goes down, and maybe we can purchase it at a better price than where it's going to be in that first couple of weeks. Is that going to work? We don't know, but I think smart money is on looking at statistics, looking at history, and trying to basically make it an intelligent decision instead of an emotional decision. And so The other thing, and this goes hand in hand with both of those, is that people might abandon long-term strategies. We put together a plan for somebody. We have a long-term strategy. If you don't have a plan in place, or you're waiting to put a plan in place, it's pretty easy to abandon a strategy that you don't actually have, right? So we want to make sure that when we put this plan in place, and with clients that we're helping them basically stick to that long-term plan. And that could be, if we do see a big market downturn, we do a lot of what we call opportunistic rebalancing. So market goes down, instead of getting scared, right? We want to use that opportunity as a time to maybe buy some things when they're cheap, and optimize the portfolio over the long term. So I guess the whole point here is that one bad emotional decision can cost decades of financial advisory fees that you'd pay on that account. And we've all seen people make that mistake. I've seen people, basically have their accounts go down by hundreds of thousands of dollars, decide to sell. And it's, if we would have had them as a client, or if they would have, listened as a client, just listening to the advice would have paid for years and years of the financial advisory fees that they paid to have that advisor help guide them. So I think just not underestimating what that emotional kind of support during those volatile times can do for a client as well.
Yeah. And another, I guess, less technical topic is the compounding effect of delay. When I hear that, I think of a lot of things. If we kind of zoom out and look at, compounding obviously is compounded rates of return. Everyone knows compounding is the seventh, eighth wonder of the world, right? It's a beautiful thing to have compound interest. But those decisions that you make over time that compound on each other, I'm thinking more along the lines of like a life insurance policy. So you might be 24 years old, no kids, your first job. Someone approaches you to buy life insurance. Hey, you get $1 million for, I don't know, $15 a month, whatever the number looks like. Well, I don't need it now. I'll wait until I got a family. I'll wait until I've got a mortgage. I'll wait until I get married. You keep waiting and waiting and waiting. Let's say you're 35 years old. You've got your life together. You're kind of figuring stuff out, and you approach the life insurance conversation again. That $15 a month premium for the same $1 million policy, now that's up to $90 a month, and $1 million might not be enough at that time. So you've waited and waited and waited and said, oh, I'll get it next year. I'll do it next year, yada, yada, yada. Now it's more expensive. You don't have the proper coverage that you used to have, and you got to spend a little more out of pocket to get the proper coverage. Same thing goes for trusts and estate planning, wills, all that stuff. The longer you wait, the more complex your life gets, the higher expenses that come along with some of those things. So sitting down with us and we're not going to iron everything out in the first year. It takes time to kind of get some of these things in motion. But delaying the inevitable decision sometimes will cost you, whether it's real dollars, emotional dollars, whatever you want to, assign to that decision, it can cost you over time from a compounding perspective. So when someone waits 10 years to do something, they're not 10 years behind by any means. They could have a great living, put a lot of money in their 401k, et cetera, but they might have missed out on those little things outside of your investment accounts that you just might not be thinking about. So that's a little tidbit on the non-technical side of things.
Absolutely. And even the decisions, other decisions, it's like, hey, if you take a withdrawal to go purchase whatever it is, that compounding effect of that money not growing is also could be pretty substantial.
Oh yeah, big time.
That they need to look at. But you touched on Roth conversions earlier, and I kind of want to reiterate a couple of things, because I think it's, when it comes to the cost of waiting, I think Roth conversions is one of the bigger items. A lot of our job obviously is reviewing a financial plan, doing a financial plan, looking at tax efficient ways to get your money out of your pre-tax accounts into either a non-retirement or a Roth. And I think that's one of the big misconceptions is, Roth conversions can be done at any time. And while that's true, the most valuable Roth opportunities are often in a very, very short window of time. And if you think about it, if you are 65 years old and decide to retire, you probably just got done with your highest earning years of your career. Now there's a window of time between 65 and age 75 for most individuals, or more individuals coming, before you have to take it out. And you mentioned it, Ethan, it was the required minimum distribution, and that's what the IRS requires you to take out. Well, that 10-year window of time, if done right, if done, with good planning, you can oftentimes get money out of that pre-tax 401k or traditional IRA into a Roth account at a much lower tax rate than you defer to that. So if you were deferring during your working years at 22 or 24%, now all of a sudden you have very little income, or you've structured it the correct way, maybe in some non-retirements, to take that money out, you're able to get that money out of that retirement account at 12% or so. Just again, those windows of time are short, and you need to have a plan prior to that window opening in order to take advantage. And another, Jeb, you mentioned it, kind of leaning into investing when markets, provide you that opportunity. When they draw down, it's a good time to sometimes reevaluate, lean into some of those investments. A market decline can also give you a pretty good opportunity to do a Roth conversion. If you think about it, if you have $1 million IRA and you're wanting to convert $100,000, well, that's about 10%. Well, if the market drops and that IRA is also declines, now you still want to convert $100,000. It's not 10% of the IRA. It might be 12 or 15%. So it's a much, much larger percentage that you're able to convert, reinvest it back in your Roth, and then enjoy the recovery after, whether you've already paid taxes on a much lower amount. So again, this window of time, is there. I think there's a lot of planning that needs to happen on the front end of the stuff, so you're available to make those decisions when they arise.
For sure. So just kind of some closing thoughts, right? Is that, and number one, hopefully, obviously this goes out to our clients, goes out to some prospects and whatnot. And this isn't necessarily meant to be a sales pitch of hiring an advisor, but if you do have a loved one that has talked to you about, hey, I'm gonna hire a financial advisor, and has talked about doing it, I think the goal here is maybe give them a little nudge, right, and help them move forward with that. And I'll tell you things that we hear a lot when people are thinking about it is number one is, I'm going to get serious later, right? Like right now I'm busy with a lot of stuff, or I guess that those go hand in hand. Is I'll do it when things calm down, or I'll wait until retirement gets closer. And I think, all of those things, number one is do it when things calm down. That is a valid reason, right? I think there is a little bit of work to get to go through the process of getting a financial plan. You've got to track down your statements. You got to figure out how much you're spending every month. You got to figure out what you want to do in return, not necessarily what you want to do in retirement, how much you think it's going to cost you to live, all those sorts of things. But the short-term pain, I think, of getting all that stuff together, pays itself back in multiples, down the road by, number one, just hopefully peace of mind and confidence in what you're doing. And then number two, hopefully it helps you have better results over time. And I think that there's a lot of statistics that say that it does typically help people have much better results over time when they have a financial advisor and have a written financial plan. So what I'll tell you is, every year that passes without a coordinated financial strategy, it's just another year of potential missed opportunities. And every year that you're working with a financial advisor, it's another year of potentially capitalizing on those opportunities. So any other closing thoughts?
No, it's kind of the standard paralysis by analysis situation. We see it all the time. What you said, Jeb, earlier, you talk to someone 1 year and then they don't make a decision, then they come back around 5 years, still haven't made that decision. It's the most common thing, we see when we're talking to new folks. So,
yep. If it's funny, sometimes we take it personal. We're like, well, they must not have wanted to work with us. Well, that's not the reality. They just, it's going through that process. There's a little bit of pain up front involved in getting from one side of it to the other. Right.
Right.
And so, anyway, well, this has been productive, and this is Metcalf Money Moments Podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management is are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.